Yeah, hi, Mike here. I'm in the Bahamas visiting with Dave Scarica. I'm actually at his house, and you could see the wonderful view at the beach. And I'm actually things just kind of worked out that I came down here just for a few days. I'm flying back on Monday. But it seems like we're approaching a time in the financial markets that will be a real turning point for the next couple of years.
Yeah, like one thing that we've been waiting for in the markets, and I've been selectively shorting some stocks or buying put options on some stocks, etc. But the one thing we've been waiting for is for the breadth to deteriorate. What that means is the market is made up of stocks, obviously, but because all market indices are market cap weighted, meaning that a larger company like Apple will have a bigger influence on an index than a smaller company, right? Like Apple, say the biggest company in the NASDAQ 100 and the smallest company in the NASDAQ 100 is going to have a lot less influence over that index. But you want to see the broad index go up, all these stocks go up, and usually at the end of a bull market, and this happened in 2000, happened in 1987, and happened in 2007, you only have a handful of stocks kind of driving the indices higher. And we've finally started to see that in the last 2 to 3 months. Actually, in the NASDAQ, we've seen that for the last 6 months. So now it looks like finally we're in these final stages where people are hiding in either the growth names or the big large cap tech or multinational names. But most stocks are actually kind of waning and showing a lot of sign of weakness.
Yeah, I mean, you put out a book several months ago titled Collapse, explaining why the stock market's overvalued, why this bubble has been created by the Fed Reserve. Great detail. Anyone can buy the book and read it. And myself, I'm not short at the moment. I'm not betting against the stock market as we make this video. But I may start
and it's been tough, so...
Yeah, well, there's a good chance of me to start making some adjustments when I get back home. But the thing is, like, I have written negative things about the stock market all year long, saying it's risky, it doesn't make sense as an investment. And earlier in the summer, I went to the Las Vegas Money Show and wrote this thing in my newsletter saying this is going to be the last hurrah of a generation, this rally. And all along, I'm just saying there's three things that make a bear market. Overvaluation, and we certainly have that, and your book goes into great detail on that, and which sectors and stocks can really get smashed. But the other thing is crazy sentiment. The surveys showed that a long time ago. But the third thing is a narrowship of leadership and a breakdown of the internal structure in the stock market. And that is taking place now in a dramatic fashion very quickly just over the past couple of weeks. And that's what we've been looking at together as I've been down here over this weekend. So that makes it look like we're really at a turning point now.
The one thing I always thought that ever since the Federal Reserve did their QE 3 or 4, whatever you want to call it, program, where they're printing $85 billion a month and they really juiced the stock market, was that that what you're talking about, that breadth and that leadership would deteriorate very fast because it was artificially induced by the Fed, and you basically got the market going up in this 45-degree angle since November 2012 with nothing more than a 5.4% correction, which is really unnatural for markets to trade for 2 to 3 years like that. So that when you did erode, you would erode fast, and then finally when you correct, you would correct quite fast and hard as well. And if you look at like the market, it has held the 200-day moving average on every correction since that November 2012. So I think that when you break that, and if you go look at the last real correction, which is 2011, when it broke that, the market went down for about 2 weeks. And believe it or not, it actually went down almost 18% in 2 weeks. So that's what I've always thought. And I've kind of been shorting and playing weakness ahead of that. But the problem is that when you're on this 45-degree angle, you don't know when it's going to end. It's like, could it go up another month, another 2 months, another 6 months, whatever. But you know when it breaks, the break is going to be huge. So I've been trying to actually find stocks that are showing signs of blowing off or showing signs of breaking that hopefully will go down, even if we just continue to see this narrowing in breadth and narrowing in leadership, right? But we know that when this does break, it will break break quite hard. And well, actually, even one difference between now and the late 90s, I don't mean the economic backdrop. I'm just saying in general terms is in 97, 98, 99, you had 10% corrections in the stock market every year. And I think that's what kept the bull market going into that bubble, that you had this fear, you had these corrections, people would get scared and shaken out, and then the market would go back up. And we haven't had that for the last 2 years. We've had this very unnatural Fed-induced bubble where the market can keep going straight up. And, like, for example, go look at the markets like Hong Kong, like Taiwan, like a lot of the emerging markets, which have underperformed the last 2-3 years. Well, it's because these countries aren't printing $1 trillion a month, so their markets are behaving more naturally, right? But what I'm saying is we're seeing this narrowing in breadth, and when we break these moving averages, the major averages are going to fall the rest down. Again, the example I was telling you earlier is last thing here is in the last 6 to 9 months, stocks like Microsoft and Intel have really come back and been leaders again, really for the first time since like 99, 2000. And Intel is up roughly like 35% year to date, and so is Microsoft. You think like big saturated companies like that are going to go up another 35% in the next 9 months to prop up the indices? That's probably not going to happen. And with all these other stocks breaking down, then the major average is going to fall. Like the last example I use here is at the bottom in August, only something like 35 to 40% of stocks, actually it was 25%, sorry, stocks, on the S&P 500 were trading over the 50-day moving average. And it was only about 30% on the NASDAQ. Well, the NASDAQ's already back to 30%, and only something like 40% of stocks, I think it's 44% of stocks on the S&P 500 are trading over the 50-day moving average. So these stocks are all beginning to kind of decline, but you have these few large, like I mentioned, Microsoft and Intel, you have these few large companies holding everything up, and it's just a question of when do those companies and then the indices follow the majority of the market.
Yeah, that's what's going on is we're looking at this and seeing what the sectors are doing, what these stocks are doing. And if you look outside of the United States market, the European markets are very weak, Asian markets are very weak. These things are already breaking down, and gold, of course, has been declining, commodities have been declining. The crazy Bitcoin thing has fallen 50% in just the past 6 weeks. So you're seeing weakness all over the place. But most people who just watch CNBC or whatever, they have no idea that this is occurring because all they're paying attention to is the Dow and the S&P 5 and the NASDAQ. They don't even know what the individual stocks that make those averages up are doing. If you look at that, a third of the Dow is below the 200-day moving average. What is it? Something like 35 or 38% of the S&P is below the 200-day moving average. The NASDAQ has even worse weakness. The Russell 2000, of course, has been declining for quite some time. And I think that these are signs that the bull market is coming to an end and things are starting to change, much as in the first quarter of 2009 was the end of a bull market and
end of the bear market,
end of the bear market and started this bull market. The summer 2007 was the end of the bull market preceding it. Now I think we're at a similar time where the next couple months things are making a transition, and that's not something we've been able to point to the evidence of this internal deterioration. But now here it's taking place. That third peg is happening, and that should lead to a swift and violent correction over the next couple weeks. And then if the bear scenario is going to play out, more deterioration after that. So we know what to look for and what to be aware of and to make adjustments for the years that follow. And if I'm right too, one benefit will be eventually the gold market will emerge after the stock market pulls back. Hopefully it's already pulled back as much as it has, but we should see a powerful rally there and then a bull market, because I think the end result will be Fed Reserve printing money at some point and so forth. But what do you think people should do or whatever, be very aware of? Or what's...
There's a couple other things that have kind of changed as well, is that the junk bond market and the high yield credit and corporate credit market is starting to roll over. We've seen, and this is the first time, again, since about 2011, we've seen a correction like this, and then the problem is with all this financial engineering and these companies borrowing money to buy back stock, etc. If they don't have that outlet to do that, that puts a big buffer underneath the stock market, takes it away. It's like Wile E. Coyote falling off the cliff kind of thing, right? So that's another big factor. And then the dollar is also rallying, similar to what it did in 2008, where you got this. That's almost a sign of that. It's not. I don't think it's because of U.S. strength. It's because I think the market's anticipating the end of the taper and maybe raising rates, and it's tightening financial conditions. I think that's why really the dollar is kind of rallying, right? So it's like the yen, right? The yen used to rally because everyone had the yen carry trade where they borrow at zero in yen and go speculate, and then every time the market would implode, the yen would rally. It wouldn't rally because Japan is a great economy. Japan's the opposite. It's a terrible economy. But it would rally because everyone's got to close out their positions and then pay back their loan in yens, which means that they got to buy the yen to then pay back those loans. So that's kind of what's happening in the dollar carry trade. So, but these are, and commodities have also broken down recently, and these are all interesting because this is something, again, these things have not happened in the last year or two during this rally. So these are the things that are all showing tightening financial conditions that, again, these large cap stocks and a handful of stocks are really ignoring. So my scenario all along has been, and this is why I'm long some gold and gold stocks, I haven't been quite as aggressive because in the last year, I just came to the conclusion that what has to happen is what you just said. The market has to crack, see this violent correction, phase A, phase one, and then the Federal Reserve will then, maybe they won't print right away, but they'll get off this this hawkish stance that they're going to raise rates next year. They'll just say that rates are going to stay zero for the foreseeable future, and then when the market really tanks and is down 30% from its highs or something, then they'll try to fight it with money printing. And that is when gold will go crazy. But I think that gold, after that initial correction in the stock market, will really begin to outperform because it will begin to anticipate. It will sense that now this has changed. We're at an inflection, that there is no raising rates. There is no tightening monetary policy. We are going from tightening to loosening.
Yeah, I think the key takeaway for me, like what I want people to get from what we're saying is, look, I know the stock market has gone up at a 45-degree angle since December of 2012, and as people who are in that make money, whenever people make money in the markets, they get excited, they feel like they're doing the right thing, and an echo chamber of sentiment kind of evolves on television where everyone is bullish and you can't doubt the market. And early this month, they were even saying there's no possibility of a correction this year because the August drop was so short-lived, and people become very complacent and kind of stop paying attention to what's happening. And what I want people to do isn't necessarily like sell everything they own or get scared or something, but just to listen and start to pay very close attention, because if we're right, things are starting to change, and these changes will be very clear if you pay attention to them. But 99% of the people aren't going to pay attention to anything. Well, and that's what I really...
I have one of my subscribers, and he knows who he is when he watches this video. I think actually he's one of your subscribers too, right? And he sends me these funny little emails from a buddy of his that every time we have these days when the market's way up and gold is down, it's got a box of the tickers, right? He's like, oh, same day as usual, and so the Dow's up, S&P's up, gold's down. Maybe even in Canada, like the TSE, because it has more commodities weighting or gold, precious metals weighting, will be down, and he'll just like laugh at it. And he still sends these on these updates in the market. And what I'm saying though is what his friend doesn't realize, what people don't realize is that, again, like we just said, the internals of the market are now deteriorating. They may see the S&P like on Friday, the 26th, or September 26th, up 1%, like 150, Dow's up 150, S&P's up 15 or something, and they think, oh, it's just another rally, but they don't realize that the internals of the whole market are really deteriorating here, right? So, and that is ultimately going to lead to big declines in the market when this thing finally rolls around, and that's kind of what we've both been waiting for. At this moment, is that this kind of technical deterioration, and then we're talking about how we need all these stocks in the market to go up. We need good breadth, right? But the problem is the average person doesn't own some obscure stock in the NASDAQ or Russell 2000. They own Intel, they own Microsoft,
General Electric.
General
Someone
Electric.
told us yesterday they own General Electric.
Yeah, Disney.
And Disney.
Yeah, and Disney and all these things. So as long as those stay strong, even in the tech sector, maybe they own Facebook or something, right? As long as those stay strong, they don't really notice all the internal weakness. And go look at October, again, 2007. Go look at March 2000. Those big cap names are going down. Like in Canada, I remember no one really noticed that a bear market was brewing in 2000 because that's when I started out in the industry, is that people were all writing me that, like they're all happy because JDS, Uniphase, and Nortel were going higher, right? So, and JDS, Nortel went bankrupt and was a fraud, and JDS, Uniphase basically went to zero, like went to down 99%. So, like, as long as these big caps hold up, they don't really notice it. And that's why they're the last to go, because people own them, they feel safe in them, and then finally the deterioration kind of finally hits them at some point. We just don't know when it happens. Does it happen October, November? Does it happen next year? I feel that due to the rapid deterioration of that kind of those technicals, it is going to happen between now and the end of the year. It is going to happen within the next 3 months. And just look how quickly it can happen. Like I said, even if you just look at 2011 was just a correction, or 2010, that correction. These are 15 to 20% corrections that basically take 2 weeks to drop. And what's interesting about both of them is they both happened at the end of quantitative easing cycles. And as soon as the Fed was not there to support the market, and my argument is 15 billion is basically like printing zero. It's not really supporting the market at this point. Is that at some point that all kind of falls apart. And the reason I think it's going to be a bear market and a big bust is that, again, we're seeing this internal erosion, and then we've talked about the sentiment. This kind of bullish sentiment that we're seeing right now is indicative of the sentiment that happens at major market tops.